And welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is 11/15/21. And, well, is the Fed losing control? Well, maybe they've already lost control, but they always did control the narrative. But maybe now, not even that. They've controlled the narrative probably since their creation. Well, let's find out from dollarcollapse.com's John Rubino where we're at here. John, as always, happy Monday.
Hey, Kerry, happy Monday. Yeah, the narrative is everything in a fiat currency world, right? Because it's all just a story. And for the last year, the Fed has more or less gotten away with the story that, we are going to see some higher prices, but it's just a snapback from the pandemic lockdowns and everything. And it's transitory. That's the word they've been using. In other words, it comes and it goes and normality will return. But it's been a year and prices are going up pretty dramatically still. I mean, in fact, they're inflecting upwards right now. It's not even slowing down. So, if you go to Starbucks, we'll start. You fill your tank up with gas on your way to work. That's way more expensive. Then you hit Starbucks on the way, and coffee has doubled in the last year. So presumably whatever you get is way more expensive now than it was. And people seem to be figuring it out because it's hitting them in their own lives. It's not some abstract thing like, oh, yeah, stocks and bonds are up and that's asset inflation, but that doesn't matter. This is real. This is cost of living. And people are starting to act accordingly. You're seeing stories of panic buying out there where people are starting to turn into preppers. They're buying a lot of extra stuff because they don't want to have to buy it 6 months from now at what they're afraid is going to be a much higher price. And that is affecting the financial markets now. You're seeing, commodities have been spiking all year long, but now inflation hedges, things you buy because you're worried about inflation, like gold and silver, are starting to ramp up. So it's starting to look like people just don't believe the Fed anymore. And unless they have some, trick they can pull to change the trajectory of a lot of prices right now, it's only going to get worse going forward.
Well, but nothing to worry about. It's all transitory, so we should just go about our merry way. John, this reminds me of the late 70s. The 70s, the decade was known as an stagflationary decade. But if you remember, inflation started getting close to double digits in those last few years, 77, 8, 9, and people were actually buying stuff so that they didn't hold on to the depreciated currency. It was rather shocking. So even though most of the people alive today weren't alive then or were too young to remember, their behavior is emulating exactly the same kind of behavior that we had in the 70s, except that it's happening a lot faster. Initially, people were concerned, but they figured Vietnam's over, the government has got this under control. We had 2 oil shocks, remember 72 and 75, if I remember correctly. But eventually they just started going for hard goods. And that's when we saw gold have its huge run up, where that was a record that stayed there for 30 odd years. Here we are. It's back to the future. Deja vu all over again, as our good economic philosopher Yogi Berra would say.
Well, yeah, it takes a long time for people to change their minds. And then it takes a really long time for people to change their minds back. So that's the risk that the Fed is running right now, is that people didn't grow up with inflation. They don't expect it. So they're very slow to come around to thinking that this is the new reality and it's going to last forever. But if we wait very much longer to throttle the current inflation, that's what people are going to start thinking. They're going to just think, well, okay, we live in an inflationary world now, and I better start acting accordingly. And back in the 1970s, which is turning out to be a pretty decent analog for what's going on now, if you had a half a tank of gas and you drove past a gas station, you would swing in and top up, right? And that's why there were lines at all the gas stations, because everybody was kind of, in effect, panic buying gasoline. And same thing with stores. If there was something you were going to need, toilet paper, et cetera, things that you were going to eventually have to buy, you buy it right away. The financial markets were very unsettled by that. Bonds were the worst thing to own in that decade because bond prices are the reciprocal bond yields, and bond yields went up into double digits. And in some cases hit as high as 20%. Some bonds were yielding that during that decade. And, if that starts to happen now, it's game over for this financial market, because we couldn't handle even moderately higher interest rates. And so if they really start to rocket up from here, then the whole system will fall apart. And so the key thing you want to watch now were really two things. One is wage levels, obviously, and I'll get back to that in a second. The other is just interest rates, the mortgage rates, the 10-year treasury. And those are things that have the potential to blow up the economy if they go the wrong way. Now, wages might be one of the reasons why they end up doing that, because, companies can't find enough people to run their businesses now, and they're having to get more and more desperate. They're doing away with a lot of the old requirements, like a college degree, or no police record, or a positive drug test, or a successful drug test. They're doing away with all that stuff now just to get workers in the door. And of course, they're having to pay more during this process. So if you have to pay people way more, which that's a great thing, people deserve way more, especially people who generally work with their hands. They've been totally screwed over in the last 20 years, and they deserve to make back what was taken from them. Well, that's wage inflation. That's the thing the Fed is terrified of. And it's the one thing that will force the Fed to raise interest rates. And we're kind of seeing that now, right? McDonald's paying $21 an hour for burger flippers. And
that's a sign-on bonus. Don't forget that, because burger flippers are really a scarce commodity now. Hey, just think how many orders there are for Flippy the burger maker at fries maker. Man, those people, their wage inflation is going to be short-lived.
Well, yeah, I mean, that's the second stage, or one of the later stages in the process. It's automation, for sure. But in the meantime, I mean, that's years away. And in the meantime, people are making a lot more money right now. And the Fed is under increasing pressure to do something about the fact that the price of everything is being pushed up. So, we have some big decisions that have to be made out there somewhere, because the Fed, already, they've kind of made the decision to let the current inflation run for a while and do this little tiny tapering that isn't even really tapering, and push higher interest rates off into the indefinite future. They won't be able to do that indefinitely. That's going to be a decision point where everybody is telling them they have to raise interest rates. And if they don't do it, that kind of capitulation will just light a fire under every asset-related financial asset, and crush the ones that are the opposite. So it'll be fascinating to watch this process play out. And there isn't much time, because you mentioned the levels of inflation that happened in the 1970s. And we're reporting lower levels now, but only because we changed the reporting methodology.
Correct.
And we're still using levels or 1970s style inflation calculation. We would be that higher. We're higher right now. We'd be reporting double-digit inflation. And in most people's lives, that's what they're seeing. I mean, if you're a coffee drinker, you've seen 100% inflation. If you're buying gas, pretty close to that, pretty close to 100%. If you're heating your house with propane, forget it. There are triple-digit increases in a lot of things that people use day to day. So the instability is a very real prospect here coming soon, because if the Fed doesn't tighten, inflation starts to spin out of control and people start to act accordingly. If they do tighten, higher interest rates start bankrupting half the world, and you get the real danger of a deflationary crash, something like 2008, 2009, only much, much bigger, because there's no fix. We can't just start a new round of QE twice as big as the last round, because then we're into numbers that will terrify the parts of the market that are afraid of inflation. So we're almost at the point where it's clear to a lot of people that there is no fix for any of this. And that's always been the end point for the whole sound money / libertarian / gold bug analysis of the fiat currency world. And it took way longer than it was supposed to, but at long last, we're almost there. We're reaching the point where we have to make these decisions.
Well, so there's two ways this could go. One is what our good friend Michael Pinto says, and Michael's a pretty savvy guy, and the Harry Dent argument and all that, which is basically they're going to taper, they're going to stop printing money, and that is going to lead to a major deflationary depression. Asset prices will be going for half or less what they are now. Figure housing and stocks or stonks, as Elon Musk would call them. And then there is the Craig Hemke, Turd Ferguson scenario, which is, hey, Powell wants to taper. When they asked Biden if he was going to reappoint Powell, he said maybe. He hedged on it. And then he had a meeting at the White House between Brainerd and Powell and whomever really is running the country. And from that, interest rates went down. The rate on the Treasury went down, I think, 16 basis points in one day, which was a pretty huge move. It's like, on the one hand, do we crater the economy by basically tightening? Or on the other hand, do we just keep the spigot open and then threaten the currency? And it was always going to come down to this, John.
Yeah. See, the difference between now and in the past was that it was always out there somewhere, guaranteed to happen, but we didn't know when. Now we're kind of there. If 6% inflation doesn't do it, then that is a capitulation on the part of the Fed. Even if the Fed just shuts up and doesn't do anything about 6% inflation, it doesn't explicitly capitulate. We'll all take it as a capitulation. If the Fed is going to let this happen, that means they're going to let anything happen. And then we need to adjust our portfolios to take into account the fact that we've got inflation forever now. We have an impotent Fed and rising prices, and we're going to have to act that way. And that's when these markets have just been out of control, because who wants bonds? Who would want a government bond that pays you 0.35% when inflation is 6%? That's a negative 5.65% yield, right? You lose 5% of your capital every year in a bond like that. So who wants that? Nobody. And if the Fed's not going to buy them, but it's not going to raise interest rates to try to slow down inflation, then you need to be out of the bond market altogether. And the bond market is bigger than the stock market. So this is a huge deal when it happens. And just based on the numbers that we're seeing out there, we may not be that far from it happening, because everybody knows there's inflation now. You can't live in this country without realizing that your prices are going up like crazy. I mean, if you're a home buyer, if you're putting gas in your car, if you eat, your prices are way up. So here we are, and Thanksgiving kind of brings that home, because there's a standard Thanksgiving dinner.
Yes, I was going to talk about that. Please tell us about it, because we've been tracking that for a decade since I've been doing this show, and it's flashing bright red now, isn't it?
Well, yeah, because, people kind of remember what it cost to do Thanksgiving last year. They remember what they paid for their turkey, and, potatoes were $1.75 a pound, and they kind of know all that because it's very recent. Now they see all these numbers being much higher. And if nothing else brought home the idea that we're in an inflationary environment, this is going to, when people go out and their turkey is 50% more. And potatoes, all of a sudden, are kind of expensive. And this is the kind of stuff that you just don't expect, because those things have always been cheap and plentiful for our entire adult lives, for you and me, and for the entire lives of most other people that are out there doing Thanksgiving right now. That's never happened. So this is new.
Yes. Let's not forget here that Thanksgiving dinner, it's supposedly up 10, 20, 30%. Some people are saying that the cost of the dinner is up as much as the cost of the turkey could be $100 itself. And then we look at the fact that if you have a mortgage, if you're a debtor, all right, this is a great time, because with 14% inflation and 3.5% interest rates, 3% interest rates, you're talking 10 to 11% of a discount, negative interest rate on your mortgage. So all of these things are going to play a part in what's coming next. Just remember, inflationary times, it's a great time to be a debtor, especially before interest rates go up and the rest of the world catches on. Something to think about. But if you're a debtor for an income producing asset, it's even better because you get to raise your prices, you get to raise your receipts, your revenues, and the cost of that asset actually goes down on an inflation adjusted basis. So remember, do things right. Inflation's your friend. And John managed to get back. John, you had a bit of a power surge there on your internet, and your power is the beauty of home ownership. So like I was saying, we've got negative real interest rates on mortgages of somewhere between 10 and 11%. All right. Because if inflation, as John Williams Shadow Stats says, is running 14% and you're able to finance your home for 3%, that is a negative real rate of 11%. And this is why it's good to be a debtor in an inflationary scenario. But if the Fed actually does tighten and implodes the economy and asset values, then you could be getting the reverse effect.
Well, that's the dynamic. When inflation starts to pick up, everybody tries to buy real stuff because they know it will go up in value. And usually they borrow to buy that real stuff. So you get a hyper leveraging of the economy and crazy high prices for the real things like houses. But then that inflation pushes up interest rates, which crash the markets and send the price of those things down. Houses, after the peak of a cycle, you get a housing bust and house prices tank. And then everybody who bought right at the top feels like an idiot, because it's a leveraged asset. If it's down by 30% and you put down a 10% down payment, you've lost triple your money already, and that happens a lot to people in the housing market and to other, leveraged assets, buyers. And that's kind of what we're looking at now. We've got this cycle going where we're in the inflationary part now. Everybody's buying houses hand over fist. It's a bubble now, by the way. Maybe we talk about that next time, all the specific reasons why housing is now a bubble again. But yeah, I think the people who buy houses now, you buy a house right now, you probably feel smart for another year. And then there's the real danger. You're going to feel like an idiot out there 2 or 3 years from now, because when this cycle turns, with house prices at record high levels and mortgage rates at record low levels right now, it can only get worse from here, and it could get much, much worse. So that is why regular people are victimized by a fiat currency system coming and going, because they depress your wages, first of all, and then they sucker you into buying over expensive stuff, and then they crash the market. And you lose both ways, and there's no reason to think why that is not going to happen again. The only hope out there that we get off this treadmill is that we have that monetary reset and go to a system that benefits regular people, like sound money. The gold standard was great for working and middle-class people because interest rates were high enough in relation to inflation that you could save money and generate a real return on your savings. And all the other good stuff that was out there, enough jobs, but not a crazy number of jobs. Real estate was affordable. It was a much better environment in general for regular people than this is. So maybe we go back to that, and in the meantime, gold bugs will make a lot of money at least. That's the one bright side of this investment environment right now.
Yeah. And we should just quickly note the complexion of the precious metals markets has completely changed over the past 3 weeks. And it looks like it's going to stay that way. One of the things you see when gold is in a bull market and it's getting ready to take off, is you get these things called upside reversals. You wake up in the morning, in the overseas market, the price of gold is down $5, $10. And then when you drink your last cup of coffee at around 4:30, 5 o'clock in the afternoon, you see that gold has reversed and it's higher by $20 or $30. Now, that's something we saw major in 08 through 11 and 12. It's something we haven't seen much of for the past 10 years, with the exception of 16 and I guess 19 during that, and then the pandemic. I think barring any major insane interventions by the Fed and others, you got more of this to look forward to. In any event, we got to run now. Make sure you go over to John's site, dollarcollapse.com. Definitely the best site when you're thinking about inflation and gold prices and why the two are so tied together and why things are about to change. And hey, send us an email, kl@kerrylutz.com. We answer all. John, we'll talk to you in a couple of weeks.
See you, Kerry.